Hello, my name is Dave Coker. Welcome to the LSBF panel discussion for the case study that we're going to talk about this afternoon. Before we get into the case, I'd like to introduce my other co-panelists. Jan, could you go ahead, please?
Yes. Hello, my name is Jan Renman. I'm based in Stockholm, Sweden. I'm a partner at Accenture. I heading the Nordic Finance and Performance Management practice. Prior to working as a consultant, I worked as controller, finance director, and I was also CFO for a large company before joining Accenture in '96.
Good afternoon, I'm Marius van Jaarsveld. I'm a partner of Deloitte CIS. I'm based in our Moscow office. I'm focused on business transformation for large multinational companies. Before that, I was working for Deloitte in South Africa, in the Middle East and the USA.
Thank you very much, gentlemen. Now, this afternoon, we're going to talk about a case study for a company called Woolworths. It was founded by an American in 1909 in the UK who had the idea that a store founded by Americans selling what in the States we call penny goods, what here in the UK they call sixpence goods. In other words, very cheap impulse shop purchases would be successful. And he was absolutely correct. Over the next 50 or 60 years, Woolworths expanded to almost 800 branches across the UK. They went listed in 2001. They went on to a very successful business history, but then they developed some problems. In the credit crunch, like many other firms, they started to struggle. They started having problems obtaining capital, working capital, and credit lines, and they were forced actually to sell their own trade receivables. Back on the farm, we'd call it your own corn, your own seed corn. And because they had to sell their trade receivables, they quickly headed to bankruptcy. So after you've read the case study, if you look at the alternatives, it seems that there's three options that management could have executed. First of all, they could have increased their margins. In other words, they could have raised their prices or lowered their costs. And that's something that a lot of companies try to do. Another possibility that they could have done would be to try to reduce their debt funding by whatever means possible. Typically, most companies try to do this by means of issuing new equity, and we'll talk about that alternative and see if there was an appetite or see if that was really a possibility. But the third alternative is a little bit more interesting. It's a little bit deeper because maybe the company wasn't run effectively, and perhaps management wasn't executing well. And in boom times, when the economy was doing very, very well, their incompetence was basically hidden. It was shielded. But when the economy moved against them, is when their incompetence or their poor execution skills were revealed. And we're not really sure exactly what which alternative would have come to fruition, which would have saved the business, but we'll talk through the point. So any of you gentlemen want to take the, I think that margins, they should have increased the prices.
Yeah, I think I have a general point to begin when looking through the case and the statements they have. To me, it seems like overall they grew significantly over many years. It was funded by debt. It seems like they didn't manage the company in a good way over many years. It's difficult to do a quick fix when things have been sort of running out of control for a long time, and that was my initial reaction when looking through the case.
But if you look at the basics around the profit margins, gross profit, net profit, all of that were, if you look at it pure theoretically, all of that were in line. I think the one thing that stands out to us is the amount of debt that they had on their books, and I would like to agree with Jan is that if you look at the business over a long-term period, I think there were some fundamentals that gone wrong through the process.
That's a good point, and it looks like they were running the business effectively at that time, or sort of misrunning it. But then when the macro conditions turned against them, when the cost of debt became so high, and with debt withdrawn, then they got squeezed and they couldn't recover quick enough. But could they have gone into cost-cutting mode? Could they have cut their costs aggressively, do you think?
I do think that would have been a short-term solution. I don't think that would have helped the business significantly. Cost cutting is always an option. They had a solid profit margin at that stage. If you look at the industry trend, they were well above the industry trend. So there was some room for cost cutting. But I would think that they should have looked broader. They should have looked at shouldn't they cut some of the infrastructure? They had over 800 stores. 2008. The whole online shopping was already booming, and shouldn't they have cut some of their stores or the infrastructure and move into the online environment quite sooner?
Yeah, quite true. I mean, it's good you mentioned that because I remember going into those stores and it wasn't, the stuff was cheap, but you were wasting a lot of time because there was a huge queue. And why buy something cheaper than the store across the street if you wait 30 minutes in line? So
Correct.
I think they did try.
And some of those stores were uncomfortable. It was not
Yes.
a comfortable shopping experience,
I think you have a point. And if you look at the profit and loss statement, you mentioned also about price. Could they have increased the price? Generally, I mean, the P&L it didn't look bad, really. I mean, they made a profit here for the years that we've seen here. And increasing prices, yes, sure. They could perhaps have done something. They wouldn't significantly have changed the situation, I think. They could also have taken a risk to lose volumes. So at the end, it's sort of a zero-sum game. And on the cost and expense side, it didn't look like a big issue, really. So they had probably to do something more dramatic, like looking how they run their business, the type of operating model they have. On the other hand, that takes time.
Correct.
So it's nothing. Getting rid of stores, changing your business model, is not done in 1 or 2 years, perhaps.
And in that macro environment, remember that probably the appetite for new equity just wasn't out there. So they had this huge debt load. Nobody was buying shares back then. Remember, that was the time when U.S. Treasuries went negative yield. So nobody wanted any risky assets at all, and they're all piling into U.S. Treasuries. So they probably couldn't have sold equity to reduce the debt, so they just got squeezed.
Right. No, but it's probably what they what they really needed to do. I mean, the key issue they had was in the balance sheet, the debt situation. It was sort of out of hand, and some way they before doing anything else, I think they should have dealt with that somehow. The situation wasn't easy. I mean, the recession, this type of market disappearing, so the appetite for sort of finding ways of dealing with that wasn't really ideal.
It's interesting listening to you gentlemen, because I wonder, with situations like this, what was the board doing? Because the board is supposed to provide oversight to management, and it seemed like management just had its own, they were doing whatever they wanted.
If you look at it simplistically, they took the easy way out. Get quick debt and finance the business through that. And then when the pressure started to hit, I don't think people gave the right attention. They didn't look at the thing holistically, and they didn't react to that soon enough.
Yeah, exactly. And I think that comes back to what I said initially. I mean, it wasn't well managed. It seems like suddenly things came by surprise. And of course, I mean, there was a lot of changes in this particular market where they operated, with the online shopping, the music industry going through a big change. So of course that may have come surprised them a little of the speed of the change, but the signs of the change that had been there for a long time.
That's interesting. I wonder why management just didn't do it. They had this huge bricks and mortar infrastructure, more or less, and they didn't really explore the whole clicks and mortar type of space.
Most probably some change resistance. You get that quite often in these established environments, is that people are very resistant to change. But even at that stage, if they were looking for alternative funding, if they were looking to issue some bonds or whatever, it would have been very, very difficult in order to do that at that stage, because the market conditions was just as such that there was nothing available.
Yeah, excellent point. And even though it's appealing to say, we'll just expand online, the simple fact of the matter is building that infrastructure like Amazon has, like these companies, the fault redundant 24/7 availability, so that when you click on a link, the website works. You don't get a stupid error message. It costs money.
Correct.
They just didn't have it. So
I was thinking of one thing here when looking through the statements here. There's one thing in the balance sheet that I'm not quite sure about. They have a lot of receivables, and they're running a retail business. I'm not sure how that came there. I mean, typically retail is a cash business. You don't build up a lot of receivables, but it's a huge item here in the balance sheet on the asset side. So, maybe it's something to do with the type of credit card business they're doing. I'm not sure, but that should be money that's easy to collect. And I don't know. It seems like perhaps they could have collected a bit more of that and paid off some debt.
Excellent.
I'm not sure how it worked out in their particular case, but it's something that raises some concerns.
That's a very good point, Jan. And coupling it with what Marius said, it seems like they had no problem selling, and the margins were healthy, But then now we're back down to basic execution, which tends to kill lots of businesses. They executed poorly. They got away with it during the boom times. The recession came, and like a lot of the weaker players, they were called out.
Exposed them. It exposed them of weak management.
Understood. It reminds me of that quote from Buffett about nobody knows who's been swimming naked until the tide goes out. So he sort of got caught behind at that point.
Yeah.
Correct.
Oh, very fascinating. All right, gentlemen, so don't let me put words in your mouth. It seems that we've reached a consensus by both of your unique insight. It seems the business was poorly run, and they got away with things for quite a while. And what happened was the macro environment turned against this business significantly. And when it did, the poor execution was called into, or probably exposed finally. And like what happens in the market, they were just wiped out.
I think had they not been so exposed by their huge debt, they could have survived by changing their business model, maybe managing cost a bit more, etc., and maybe looking at their asset side. But it seems like their timing were against them. So
Excellent.
It's sort of caught up with.
I think what one learned. Sorry, Jan. What one learned out of this is, there's no substitution for good active management of your business. Understand and also look forward. See where the market is going. That is for me always a sound business principle.
Wonderful. Right, fantastic insight from the panel here. It seems the consensus is that the company just wasn't run effectively. The board was lax, and when the macroeconomic environment turned against them, like happened to so many businesses back in 2008, they were exposed for the more or less fraud or poor management, I should say, the poor operation they were actually running. Once again, on behalf of Jan and Marius, my name is Dave Coker, and we'd like to thank you.